My name is Steve Peterson. I'm the broker owner of Infinity Investments, and we're going to be talking about timing the real estate market. And particularly today, we're going to be talking about commercial and investment real estate. That's what we focus on. That's what I like to talk about, commercial and investment real estate. So the basis of this presentation comes from a book that you can order on Amazon, and there's a million different real estate books out there. This book is called Timing the Real Estate Market. It's by Craig Hall, a very experienced and seasoned real estate investor who's been doing business since the 60s. So he has seen multiple market shifts, market changes, market environments. He lived in serious, and he did business in serious inflation, which we're now starting to see some inflation. But in the 70s, they had serious inflation. And the book gives you a lot of wisdom on how to navigate these times. It doesn't give you specific, prices and cap rates and all that type of stuff. And I'm not going to do that here today. What I'm going to be talking about is the fundamentals of how to look at what's going on around you. And I think that if you can apply those fundamentals about what's going on around you, then you can look and get the technical data about what's price like in apartments, what price per units are buildings selling at, what's current cap rates, what are internal rates of returns for bigger property, what are cash on cash returns, those types of things. But you got to have a basis, a foundation, if you will, of which to look at a market, of which to make some decisions. And so this book was a really, really good read. I served as president of NorCal CCIM. We have a book club, and this is one of our books of the month. And when I read this book, it made a significant impact on me. And so I wanted to share it with you and hope that you get something out of it. And a couple of the key points is, reading this book, you'll be able to recognize the peak of the market and cash in on it before it crashes, before it subsides. You'll also be able to profit from the major 7 trends affecting real estate prices, all right? Those are the really 2 things that I see for sure if you read the book that you'll be able to take away from. And the guy, what I also like about this book is he goes in depth about some of the mistakes he made and some of the money he lost in the 80s, particularly before the savings and loan debacle, or during the savings and loan debacle when the real estate market and tax laws changed, real estate market changed dramatically. And he talks about that. And I think that's important because many books that you read are going to talk about people's success, what they did, all that. What I find in real estate investment education is very rarely do you see an author, presenter, go into depth about the mistakes that they made, about the failures that they had. And oftentimes you're going to learn more from that than some of the success, because you don't want to make those mistakes. And he goes in depth about some of the mistakes he made. So please, not to beat a dead horse, but the kind of the core of this presentation is going to be based on this book. I highly suggest you have this book as a part of your library, that you read it a couple of times and understand. That being said, a little bit about me. I run Infinity Investments. We're a boutique commercial investment firm based in Oakland, California. I started the company November 2009, right in the midst of the storm that was the Great Recession. And I say storm, and it was a very difficult time. However, it was an amazing time to be in the investment brokerage business. I saw a lot of people, I helped a lot of people make millions of dollars. I made a little bit of money myself. I started a company, we got rolling. And I say it was an amazing time if you're in the investment business because of the price points that you were able to buy property, that we were brokering deals at. I mean, some of these prices were just simply amazing. And I remember because I started in real estate in 2003. And so I saw, where the peak of the market was in 07 and 08 and where those prices were. And I saw the sharp decline in 08 and 09. And the opportunities were abundant. And I was just a young pup around trying to make a deal. But I recognized And the cash flow model, by the way, helped me to recognize this. I'll talk about that later. I recognized the opportunity. And so I began vigorously, working with investors. I was already working with investors, but I began vigorously working with the investors around that time because I knew that there was huge opportunity. I also was the past president, I am the past president of the California Association of Real Estate Brokers, KRAB, in 2017 and 2018. And what KRAB is, that is the state board of NARAB, the National Association of Real Estate Brokers, the Black Brokerage Association. And we were formed in 1947 as a way and a means for Blacks in real estate to be able to conduct business. We were not allowed at that time to join the Realtors Association. So we formed NARAB, and a member of NARAB you are called a realtist. And this was a way for us to have access to be able to sell properties and build a network and do business in real estate. And we also stand for democracy in housing. And so all the fight for fair housing laws, all of that happened in the 60s and everything to today, as a realtist, we stand for that. And I had the honor of serving as president of the California State Board, the KRAB, 2017 and 2018. And I was the president of the Associated Real Property Brokers, 2015 and 2016. That is the Oakland chapter of NARAB. So I got a lot of experience working with the community, working with the realtors and supporting the idea, the concept of democracy in housing. Also had the honor of being the president of NorCal CCIM in 2018. And if you don't know what CCIM is, that's a designation that stands for Certified Commercial Investment Member. It's a designation I earned in 2012 and have been part of that local chapter since 2007. That local chapter has helped me to advance my career in many ways. And so if you're interested in commercial and investment real estate, I highly suggest you pursue a CCIM designation and you network with the local chapter of CCIM, wherever you are in the country. I've done business with every single class I've taken. I've closed business with someone in that class. So a little bit about me and a little bit about some of the organizations I'm a part of. I believe networking is a major key to success in real estate, whether commercial, residential, whatever. Making the right connections are key. On my firm, Affinity Investments, we're a brokerage and investment firm. We specialize in the sales and acquisitions and syndications of small to mid-sized apartment buildings and commercial real estate. Many of that pure commercial is going to be office, retail, and industrial. And we do those deals really as catering to our clients' needs, as multifamily business is our core and it's our sweet spot. Now, let's get into the presentation. The first thing to look at is the 7 major trends impacting real estate cycles. Now, the first 3 of these trends operate on a national, or I would even say an international, global level, and they really affect everyone. The last 4 are the local, primarily operate on a local level. And as you know, real estate is a very local business, but there are things nationally and globally that affect us all. How about the first one? This idea or concept of inflation, something that we are wrestling with right now in the United States of America. And I would hazard an educated guess that the rest of the world is also beginning to see inflation. And particularly in the United States, as we went through the pandemic, there was over $6 trillion, printed and put into the economy. I say printed, I mean, money is pretty much digital now, but essentially $6 trillion, over $6 trillion put into circulation, into the economy to kind of keep us rolling. It was a period of time where everything was shut down. You know, we weren't going to work, we weren't going to school, we weren't playing sports. We came out of that slowly but surely. Businesses were severely affected. And not saying I'm for or against the 6 trillion, but it was needed at the time, for sure, especially with the extreme shutdowns. And then here in the state of California, our shutdown was extreme. So as a result, anytime when you print money, put more money in circulation, when we look at the history of economics of any country, is it tends to have an inflationary effect. It tends to spur inflation because you put more money out there, essentially the money is less valuable, right? So we're seeing inflation for sure. I just saw a YouTube video from a very, very on point YouTuber, and he was talking about the number of 60. We're seeing inflation, the inflation rate is 6.2%. I don't know if that's verified or what. I here in the Bay Area, from the street level, walking around, buying groceries, doing business, yeah, it's at least 6.2% for sure. Now, where I'm hearing about inflation having a major impact is in the Midwest and in the South, where cost of life and living doesn't rise and fall or really rise at the rate like it does on the coast, California, New York. We see a lot of inflation, if you will, or inflated prices here in California for sure. But what I'm hearing is that you're seeing some major inflation hit the Midwest, where a lot in the South, where a lot of times the cost of living is pretty consistent. Well, house prices everywhere have gone up pretty radically. Gas prices everywhere have gone up pretty radically. Your cost of milk and eggs and pretty much everything is going up, right? And so that's going to have an effect. And it always has an effect on real estate. There's pros and cons of it, though. Real estate inflation can be a really good thing in a sense for real estate. It also can kill the bottom line. If you're operating an apartment building, a hotel, or something where you're like, for instance, we have rent control here in the Bay Area. You have a rent control building, and your rents are kind of flat because you're not able to raise those rents to the market, but your water bill's up, your maintenance costs are way up, your gas and electric's way up, everything's way up. So if everything goes way up and your rent remains flat, that's going to eat into your profits at some point in time, right? So inflation can be a double-edged sword that way. Yet and still, typically inflation brings up prices. So if you're buying real estate at decent prices and you hold it over a period of time, you could see some significant increase in value. In some periods of time, inflation has really increased rents. But we're in a weird time because this has really been accelerated by this pandemic, which is in many ways what people would call a black swan, an event that is an unprecedented event. And I don't know if this is a black swan or not, but it's certainly an unprecedented event that has caused $6 trillion to hit the economy, that has caused us to go into some inflation. Now, the next thing to look at is interest rates. Interest rates have been low, and then they went lower when the pandemic hit. And this is really what has been driving the market. People have been able to buy homes with 2 point something and less than 2%. I don't even know people who got less than 2% loans to buy homes. You have to have super great credit and balance sheets and all that. But people have bought apartment buildings at 2.8, 2.9%. This makes buying real estate pretty attractive, right? If you can buy it and you got 2.9% money, why not? Right? Especially, when your interest rate in the bank is, it basically is costing you money to keep your money in the bank. You might as well, lend it out. You're paying out 2.9%, and you got rents coming in. It makes a lot of sense to buy real estate. Now, we've seen last couple months slight increase in interest rates. I think you'll continue to see a slight increase. I don't think the monetary policy will allow them to lower interest rates anymore, even if we go into a recession, if you will, or not, or just a slowdown in the economy. I don't think we can drop interest rates much lower because we have to worry about the first thing, which we talked about, inflation. The money can't be too easy. It can't just be thrown out there consistently like it is. There can be, and 6.2% inflation. That's if that's actually what it is. That's a lot. And if you do anything in business life or whatever, you are seeing it, especially at the gas pump. I just paid $5 a gallon for gas here in the Bay Area. It's real. So they cannot simply just keep lowering the interest rates. And in fact, we're starting to see incremental bumps. And I think that's the way to go as a policy, is to have incremental bumps, because we have to have a balance. We have to have a balance. Now, that being said, the third thing, flow of funds into real estate. And these are flow of funds, really a lot, institutional funds, first and foremost, the banks, the private equity funds, the hedge funds, the investment funds, and then the individual investors, groups of investors, individual people, individual homeowners. There's a lot of money flowing into real estate, a lot of money flowing into real estate. And I don't know that that's going to change. One thing is banks may taper off. I know the Fed is going to be tapering off how much they buy, how much mortgages that they buy. So that may slow down the flow of funds in their real estate. I don't think we'll see anything like we saw in the Great Recession in regards to the slowing down of flow of funds in the real estate. Great Recession was also a black swan of sorts, because mortgage lending, October 08, I mean, the rest of 08 was mortgage lending came to a style halt. It stopped. Yeah, I was in the office with, I think, over 70, 80 agents, and we closed 2 or 3 deals from October 08 to the end of 08. And it was very difficult getting loans after that. So I think now is a different time, especially because the lending environment over the last few years has been based on people's incomes. They've been scrutinizing how much money you're actually making, how much money you actually have in the bank, how much money you're actually paying taxes on, and lending to you based on that. And lending to you with interest rates, pretty low interest rates, that may be adjustable after a period of time. That period of time usually is 5 to 7 years. And it's nothing like before. We had negative amortization loans, 2-year interest-only periods, all these crazy loans that you just had to have a credit score and you could fog up a mirror and get. Underwriting for real estate has been very tight. So right now, flow of funds in the real estate is still major. Also, individual investors are still putting a lot of money into real estate. Now, we have seen, I will say this, over the last couple of months, a bit of a slowdown in the commercial and the multifamily sector, particularly. And I can just say from a feet to the street level, this summer, and it really picked up in April of last year, office property sale, apartments, industrial, just on fire this summer. And during the pandemic, for a good 6 to 12 months, it was very slow for commercial real estate. We were trying to figure out what's going on, who's going to open up, and all of that. So it was very slow. Then in April, it picked up like gangbusters. It has tapered off the last couple of months. However, a well-priced property still is selling pretty quick. Although I'm seeing price reductions all the time. However, when we're talking flow of funds in the real estate, got a lot of people in the mortgage business and the fund capital markets that I know, there is a ton of money that is allocated towards real estate. And I don't see that going away anytime soon. So that's a good thing. We are dealing with some inflation, for sure. I think that's going to continue in the next year. Interest rates are creeping up, and they got to do it. They can't keep them this low forever. But it's not going to be shocking all. And I don't see the Fed coming and say, hey, we're increasing interest rates by 1.5%. They're not going to do that. It's going to be an incremental increase over time. So the great thing is that there's a ton of money for this. So the lessons here, as you're looking at real estate cycles, is to see that, hey, we have some inflation, interest rates are creeping up, flow of funds is there. That may slow down all this overbidding and interesting activity in the market, but also create a lot of buying opportunity where you can go and buy properties with low interest rates and let inflation work for you. And you got to buy smart. And we'll talk about the fundamentals of buying and being smart if you're going to buy at this point in the market. But there's some challenges. There's some opportunities. That's my assessment of the first 3. Now, the next 4, which trends that impact the cycles, are really local. So we look at job growth. Is the job market growing? This is a weird time because in many areas of the country, and I think the Bay Area is no different, that we're having an actual job shortage. We're having a labor shortage. And what I see now, people re-entering the workforce, re-entering, looking for jobs slowly but surely. But over the last 4 to 6 months, it has been tough hiring. If you're an employer trying to get someone, especially to come in an office and sit in that office, it's been tough. People don't want to do that. They want to work from home. They want to be online. They want to have flexibility. And a lot of people were getting paid to do that. They were getting EDD money and different idle loans or PPP, if you will, and playing it safe. And so if you're out there trying to hire folks, it was difficult. Slowly but surely, it's getting better. But uh, it's really been an employee's market. Employee can kind of pick and choose what jobs they want, and employers are struggling to hire folks. Now, in terms of job growth, this is an interesting thing. And I think it's going to take some time for us to really know where we are in terms of our jobs growing. I know things slowed down a lot during this pandemic, and coming out of it, you're seeing an uptick here in the Silicon Valley, in the East Bay, in San Francisco, but it is slow. And I think that going to continue to be slow. And I think that companies are still wrestling with, are they going to fully go back in the office or be virtual, right? A place where job growth has exploded is in the state of Texas, in a city like Austin, where a lot of tech companies are relocating. A lot of people from California have relocated, and during this pandemic, a lot of people and companies have moved out of California, seeking places such as Texas, where there is no state income taxes and the laws are it's just less stringent. Like in California has a law for everything, so it makes it difficult to do business. And so in that real estate market is outrageous right now, because you've seen so much job. So what is your market doing? And that's something for us all to look at. Is your market growing in jobs, or is it shrinking in jobs? You're investing, no matter what the cycle is, you want to be investing in that market where the jobs are growing. In or out migration. Are people moving in, or are they moving out? So in the Bay Area, you've seen a big outward migration during this pandemic, particularly the city of San Francisco. And I've heard different stats on that, but a lot of people say that San Francisco lost more people in the last 18 months than I think the last 10 years combined. Now, a lot of those people moved out and now are moving back in. I will say that that's happening, but not at the rate that they just moved out. Because in San Francisco, the shutdown was so extreme, you couldn't go to work, you couldn't go and do anything, and you're paying an outrageous amount of rent or home prices. So people were figuring, hey, I can just sell my property or get out of my lease and move somewhere else, and have a little bit more freedom, or be a little bit more, like a lot of people moved to Tahoe. A lot of people moved to areas where they got more space. So you've seen a lot of out migration in the city of San Francisco. Well, I talked about Austin, Texas. You've seen a lot of in migration, people moving to that. But also here in California, we're seeing people moving into areas such as like Stockton, California, which is in the Central Valley. We're seeing people move into the Sacramento area. We're seeing people move into the ancillary areas of the Bay Area, like Antioch and Brentwood, where it's a lot more affordable and people have a little bit more space. I think pre-pandemic, people wanted to be bunched in, close to the central business district, close to their jobs, close to transportation. And the pandemic, people are now putting a value on space. So people are moving to places where there's space, such as Stockton, and that market has really exploded. And I've even seen employers set up shop out there. Amazon set up a distribution center out there a couple of years ago, and employers are slowly but surely moving to areas like that. So that might be wise for you to consider, where are people moving? Where are the jobs moving? Now, within that, if you're figuring out a place where there's some positive growth there, now you need to see what the path of progress is. What is the path of progress? And that's really down to that city level. Okay, where are they building infrastructure? I can give you an example. Downtown Stockton, they're putting all the PG&E wires, all of the electrical wire, that's all going underground. And if you drive around downtown Stockton right now, you'll see a bunch of projects where they're ripping up the concrete, because they're putting all electrical wires underground. They should have did a long time ago throughout the state of California, but that's a major infrastructure project that indicates that area is within the path of progress. And you know what follows the path of progress? New construction, right? Because builders want to build in the path of progress in areas that have in-migration and job growth, right? So you want to figure out where that path of progress is and see where the new construction is. And that's really gonna typically be a great place to invest. Now, in some of your markets, too much new construction can actually, especially in the apartment market, can drive down rents. We've actually seen that downtown Oakland recently, where I think there was like 10 or 15,000 units hit the market all at the same time. And then we're going through the pandemic, and so rents came down downtown Oakland, which actually is a good thing, I think, to help balance out the ability for people to live here and actually function. So, but in a place like the Bay Area, you don't have a lot of land. You can just build and build and build and build and build. All right, and some areas where they just build and build and build and build and keep building because there's land, that actually will drive down prices, right? So you got to really do your homework here, understanding where that path of progress is, though, because where path of progress is at, there's going to be a lot of debate. And so I really wanted to make sure I drove home these points here, because I think this is really the foundation of when we're looking at a real estate cycle. It's these first three: inflation, interest rates, full funding, and real estate. And the last four: job growth, in or out, migration, path of progress, new construction. Very, very important. Now, that being said, national trends more directly impact cap rates and indirectly impact NOI, while local trends affect both cap rate and NOI. And I would say local being, affecting your, expenses more than anything. I think it's particularly like an area like the Bay Area, where you've got a lot of extra taxes and fees and things of that nature. Those tend to go up when inflationary periods. They're going up now. That's going to impact your local trends, are going to impact more so your NOI, net operating. And that's very, very important. And when we're talking about inflation, a lot of real estate investors love inflation because prices go up, rents can go up. The thing you got to watch is those expenses going up. Very, very important. All right. And the collective interaction of these trends is what moves prices and cause variances in the highs and lows and the cycle duration, how long a cycle runs. All right. Now, this is a key thing to understand as we kind of look at the real estate market cycle model. And this is, if you look at over 100, 200 years of cycles, this has been how they operate in the real estate world. And you see over each cycle, prices are going up, right? And that's just how, prices go up over time. And that's part of how inflation helps us out. But you'll see that markets go up and they go down. And what's interesting is when they're here, when they're at the top, people, the marketplace, a lot of experts out there, we just forget about what happened when it was at the bottom last time. And we just think, hey, you can't go wrong when you buy real estate. And that can be the furthest thing from the truth. And I think, as I mentioned, the book Time in the Real Estate Market, there's a lot that can go wrong when you invest. That's why understanding this is very, very important. And what I saw last in the Great Recession, when people were buying investment properties, particularly, many people were simply buying these properties based on appreciation, the value going up, and were disregarding the cash flow model, disregarding the importance of cash flow in the real estate business. That's a huge mistake. And that's an interesting comment. If you read the book Time in the Real Estate Market, he talks about the importance of appreciation. And appreciation is a very, very important part of your investment strategy. However, you're not buying a building simply for it to appreciate, right? That is the cream of the crop, and it really is driven by the net operating income of a property and the growth of that net operating income. is in commercial investment properties. The net operating income dictates the value of the property because that income gets capitalized. Cap rate gets applied to the income, and that's how you come up with the value, right? Very, very important to understand that. And I think that we get lost sometimes in a good market because you're making easy money, a lot of money, and sometimes when it comes easy or it comes fast or you're having a lot of success, you just feel like you got the Midas touch. Anything you touch works out. And I saw so many people, you guys, so many people in the last market cycle. Hey, I just got to buy this property. I don't care. I just wanted to break even, right? That was the thing. Just break even. Don't worry about it. I got a good job. I'm making money. If the property loses some money, no big deal. Or bigger investors, we got a portfolio. Portfolio is cash flowing extremely well. We'll buy this property here, get the rents up, and you know, if we got to rob Peter to pay Paul in the meantime, no problem, right? No problem. We'll take the you know, cash flow from this other asset that's doing great, kind of feed this one over here until it gets up and running, and we're going to be no problem. Versus doing everything on a deal by deal basis, right? And I know sometimes the bigger funds have to look at the macroeconomics of everything, but I think if we looked at, and that's kind of what Craig Hall mentions in this book, you look at properties then that you buy or develop as on a case by case and a deal by deal basis using principles, some of which we're going to talk about, and using the principles of looking at and evaluating the market. That's how you can make wise decisions, even if the timing is bad. But it's also how you can make decisions on when to buy, when to sell, looking at the time. And I think that's what we're talking about today is, you know, analyzing really when can you buy, when can you sell? And looking at these types of trends will help you out to be able to figure that out, right? And if we look at, let me just kind of go through this here. If we look at this beginning as, let's say, 2001, and after 2001, after the dot-com bust, another thing that impacted everything, interest rates got really low and the market ran up. And we'll say this here is October 2008. For residential, the top came kind of in 07, but the total real estate world, I would say October 2008 is the pinnacle. And then instead of slowly, gradually going down, like things have happened in the past, we did kind of like a stock market thing where we hit that top and it dropped. It dropped off like a cliff. And I said, like I told y'all earlier, I was in the office, I was working in a real estate office. There was at least 70, 80 agents. I think we closed 3 deals from October 08 to the end of 08. And, you know, and that's not an exaggeration, right? So you can imagine how much of an impact that had on everything, right? Not to mention the stock market crashed at the same time, right? So that was an anomaly, but it happened. And so instead of this nice, smooth, easy slope, it was a cliff. And then I would say in about that cliff, that bottom for a while from 09 to 11, people were skittish on investing. People didn't know where the bottom was. Institutions didn't know where the bottom was. There was this idea of what they call toxic assets, these big portfolios of loans that were defaulted that big institutions had bought, and they didn't know what to do with them. But that was that was probably the biggest buying opportunity in the U.S. history. And maybe somebody can come back and say, well, you know, in the 80s, it was better. But I've talked to a lot of people who were buying and selling in the 80s and then bought and sold in the Great Recession. And everybody tells me, hey, look, Great Recession, that was the greatest time to buy. And what I saw, as we look at this market cycle, what helped investors make those decisions on buying properties where the rest of the marketplace said, we don't know where the bottom is at, is they looked at the cash flow model. They looked at the fundamentals to help them make a decision. And that's what I want to impart more than anything to y'all today, is to look at the fundamentals to help you make decisions, help you to evaluate what you're doing, when you're buying, when you're selling, if you're buying, what you're buying, you know, how to analyze it, how to negotiate. We want to look to that because these cycles, they're going to change, right? And there's people buying and selling throughout the cycles, making great moves. So what I would say, we topped out here in 08 and we came down here. I think we hit this bottom my opinion, 2010, 2011, and then we start coming up. Now, we've been coming up, and this is a slow, gradual come up. It more was like a steep incline. And a big part of that steep incline is we lost so much value that the properties went from way overinflated to way under what they were actually worth. And they began catching up and they caught up quickly. And then like 15, 16, we surpassed prices where we were in 2008. And we've been going straight up. We've been going straight up till about, I would say, top of the cycle, about 2019. And because in the beginning of 2020, many of you may or may not remember this, is that real estate started slowing down. We saw in the city of Oakland, we started tracking foreclosures in summer 2019. Just in the city of Oakland, residential foreclosures, there were 66, summer 19. And then we saw in February, before the pandemic, in the city of Oakland, there was 166. 166. We went from 66 to 166 in a matter of 6 months. When the pandemic happened, everything was on ice for a couple of months. Everything was on ice. Then something, and I don't know if y'all remember, the stock market dropped. I think it was like close to 30,000, or was that 30, and it dropped all the way to 19,000 in a matter of weeks. And then they passed the stimulus bill, or the stimulus, whatever you want to call it. They put 6 trillion into the market. It started with 2 trillion and all this money that they put there, but they had to continually keep pumping it in there. And so we were at the top of the market. It was stagnant. And then all of a sudden, it shot back up. So from the end of spring 2020 to now, like home prices in my area are up 20-something%, which is 15, 20%, depending on where you are. That's crazy because they were already high, right? Commercial real estate, we dropped a little bit. We kind of dropped a little bit, depending on what you were. Apartments were on ice, but you had hotels. If you had a retail property, very difficult to sell, very difficult to finance, very difficult to operate, to lease out, right? People couldn't operate a business, so it was on ice. Yet and still, home prices are shooting up like gangbusters and going straight up, right? So this is about where we are right now, above this market cycle. A pandemic has shot us up here. Now, that's a little bit of reason for concern, because we were already having inflated prices, or prices very expensive in 2019 towards the end, right? And that's when we started to see an uptick in foreclosures. Because anytime so many people buy properties, not looking at the macroeconomic, but somebody's gonna screw up. Somebody's gonna lose a job. Somebody's gonna get a divorce. People are gonna pass away. Properties need to be sold. And a lot of times in those situations, there's gonna be discounts. And I saw a good friend of mine bought a foreclosure in January 2020, and he closed one day before they took the property from somebody. So, he made some money, right before the pandemic happened, and then he sold the property summer 2020, right when everything started back rolling. So, saying all that to say is we were high in prices and we got way higher. And that's kind of where we are now. Now, it's a fragmented market. Certain neighborhoods, houses are still selling, getting multiple offers. Certain price points, houses are still selling, getting multiple offers. Certain cities, certain neighborhoods, houses are sitting. And the city of San Francisco is harder to sell. It's hard to sell a house right now, right? It's hard to sell retail property right now. It's hard to sell hotels right now. It's becoming hard to sell apartments right now. And I see price reductions. As a broker, I get all the emails from all the brokers. And I see price reductions every day across the board. Office, retail for sure, hotels for sure, and even apartments. And apartments in the Bay Area is really on a case-by-case basis. If you have market rents, there's a strong demand for your property. If you have below market rents, there is not a strong demand on your property. You really have to have factors that make up for those low rents if you have them. So we're at an interesting place, you guys. I don't see a major crash because of the way properties have been financed, the way people, even though they've had cheap money out there, a lot of money has been pushed, mortgage-wise, you have had to qualify. I know the PPP and idle loans were easy to get, whatever. Mortgages, still, you've been difficult to get. You've had to qualify, you had to put money down. So I don't see people walking away from properties like they did over here. I think that people will, there will be situations and circumstances, people may want to walk away, and there may be some opportunities. And I also think the banks are not going to do massive foreclosures and repos. They're going to work with people. They're going to extend things out. They're going to try to do short sales versus REOs. So they've got a little smarter since the last market cycle. However, I just want to say, if the market was here in 2019 and we shot up beyond that, I don't see us continuing to shoot high. I see us even. I think I see things settling out, and I think that's a good thing. I think it's a good thing for buyers and sellers. In the sense, you don't want to sell out of desperation, right? Never you want to sell out of desperation, and you want to sell before the top happens, right? But I don't think we have a crash coming. So if you're selling something or planning to sell something next year, I don't think you need to, stop everything and throw it on the market now and cut the price. It just, the property needs to be ready to go, needs to be prepared, right? Because real estate operates in cycles. And that's my point of this slide is this that's how it goes. It doesn't always go up, doesn't always go down. It operates in a cycle. And if you look at the 7 trends that we talked about before and analyze them, that'll help you make decisions, all right? Now, a couple strategies here. The contrarian timing strategy is you buy when there's blood on the streets. Essentially, that's counter-cyclical or contrarian approach in real estate investing, is you buy when others are selling out of fear and desperation. As Warren Buffett said, be greedy, be fearful when others are greedy, and greedy when others are fearful. Buy before the real estate market begins to improve. And from 09 to 11, if you were buying properties, this is what you were doing. You were utilizing the contrarian timing strategy, because a lot of people, they didn't know where the bottom was. You had these toxic assets, we didn't know where the bottom was and all this stuff. But if you're operating on a cash flow model, saying, hey, I could buy this property, even if it goes down, I'm renting it out, I'm making 15% of my money, I'm buying that property. And that's a method of you've been able to evaluate what's going on if there's blood on the streets. Now, we're not there yet. We're not at blood on the streets. And like I said, I think it's going to be different than it was before. But a lot of people are ramping up capital, getting ready for if and when that time comes, right? And so that can be some of the best time to buy real estate in history. But you really got to have an understanding of the business. Fundamental. You don't have to know all the ins and outs. You have to have the fundamentals down, right? And just buy. Don't just buy based on it coming up. Because if you don't know where the bottom's at, you don't know when you're going to see an increase. But if you buy at the bottom saying, hey, I'm making cash flow, and whenever it comes back around, you can be doing double as well, right? So that's the contrarian timing strategy. And that's something, again, I want to drive this home, because for the marketplace, what I see is the opposite of what Mr. Buffett said. When others are greedy, when the market's rolling, everybody wants in. Everybody wants to buy, no matter the cost. We just gotta get in. And then when the market falls, oh no, I don't want to touch real estate. I can't tell you how many times I pitched deals to people. Apartment buildings under 50,000 per unit, fourplexes under 200,000, right? I buy and fix and flips houses. You could have bought several houses under 100 grand in Oakland. I can't tell you how many times I saw deals and pitched them to people, and they're like, no, I don't want any parts to do with real estate right now. I don't know. But that was the time to buy. And most of the marketplace, when it's time to buy, they don't want to touch it. And most of the marketplace, when it's overwhelmed, when everybody's buying, that's when they want to go in. I think that's same for real estate, stocks, pretty much everything. For you, let's look at the contrarian timing strategy, or at least being counter-cyclical in your approach. I also want to say this: you can still buy properties and make money when you're at the top of the market. So you got to be real smart about it. Got to bring a value proposition to the property, and you got to be wise. You don't want to over leverage properties when you're buying it at the top. You pay cash for something, you can write it out. You got to look at the cash flow model. got to look at it. You got to operate it based on that. Now, when prices are going up, this is kind of the momentum strategy of the contrarian timing strategy. It's when you buy once it is clear that the real estate market is starting to recover from a low point in the cycle. It lets the market's upward momentum carry the price higher in combination with improvements that you make at the property. And really, the momentum strategy can be applied to any real estate class, retail, office, apartments, whatever. But he says here in the book on the timing of the real estate market is also be prepared to sell quickly before the down cycle. Now, this is something I've been talking to people about, and I've been doing this webinar. This is, I think, the third time I've done this webinar in the last year or 2 years, because I just want people to understand that everything doesn't keep going up. I lived through, the Great Recession. I came up in that time, and people forgot that real estate doesn't always go up. And I'm seeing that same consensus over the last couple of years, especially during the pandemic. I'm hearing people saying, "Oh, there's so much demand in the Bay Area, prices will never come down." People said that about rent, right? And rent came down during the pandemic in San Francisco, in San Jose, in Oakland, the major markets. I think in many ways, I think that's a good thing. They were outrageous, but things don't always go up. They are cycles. You have to pay attention to, right? And people are I think, falsely look at or falsely come up with their momentum strategy at the top of the market, thinking, "Hey, everything's rolling, it's going to keep rolling," right? You kind of want to catch your momentum after things bottom out and then it starts, right? Not buying at the top and saying, "Hey, we're going to roll the wave," because the wave might be coming to a close. And if we're seeing major inflation like we are, if we're seeing an uptick in interest rates like we are, all right, I don't see how that's going to continue to shoot up prices, right? However, we've seen some weird stuff in the last few years. I don't want to, not address that. We've definitely seen some interesting times. Now, when you're selling, it's important to start to sell during the upward cycle and not get greedy trying to wait for the highest prices at the top of the market, because you really are never going to know what the top is. So I know a bunch of people saying, "I'll sell in a couple of years." They want to sell, but they just want to wait until it goes up. I think when you're selling, you look at what price point going to give you the maximum return for you to accomplish your goal. Not, well, we're doing the time when it's at this absolute peak, because you don't really know what the absolute peak is, right? Don't get carried away with success and forget the basics. You have to master the blocking and tackling fundamentals of this business. And I want to wrap up about 1:45. I know I'm over that, but I think my approach is to drill in these fundamentals, and that's what I've been attempting to do in this presentation. Very important. Humility is an investor's best friend. Don't forget the basics of the game, right? Trend investing does not work forever. Good times don't last forever. Be careful to either get out in time or at least have your debt in comfortable shape. A lot of people have made a lot of money just holding on to real estate. And a way you can do that is that you have cash flow producing real estate where you have sustainable long-term debt. So if you're going out and putting debt on properties today, try to make sure that the term of that debt is as long as possible. Because let's say the market goes down and if you're making cash flow and your debt's low, hey, that doesn't really affect you that much. If the market goes down, you're breaking even, and you got short-term debt you got to pay off in 2 years, 3 years, that can be a problem. Take that with a grain of salt. Now, you stick to the basics by mastering the cash flow model, which is essentially, understanding these things. Your effective gross income, which is your gross income minus vacancy plus other income of the building, right? We're talking any product type, office, retail, that's the formula. Now you take away from that effective gross income all of your operating expenses, taxes, insurance, management, maintenance, etc. Get your net operating income. This is the line item that you really got to pay attention to at a time like right now, because these are the line items, operating expenses that can get out of control in an inflationary market. So this is what we have to keep our eyes on, guys, is operating expenses. And if you're active, I know a lot of savvy investors are watching these. They're watching things like water prices. They're watching things like gas and electric prices. They're watching things like labor prices, material prices, because these are the things that can eat up your net operating income. And then your net operating income, your net cash flow is your net operating income minus your debt service, your mortgage payments. All right. I put here, this is why we invest. So the cash flow model, understanding this cash flow model is very simple, can really help to guide you through the cycle versus just saying, hey, I'm buying this property because it's going up. It might not. So if it doesn't, do you have the cash flow to weather the storm? And if it does, do you have the cash flow to maximize the price? Right? Now, here are key indicators to help you evaluate this, right? Capitalization rates, cap rates, as it is known in the business. All right. And what I put here is that we might see cap rates go up 1 to 2% in the short term. In the pandemic, in certain areas, they did go up. But what also happened weirdly is sometimes some of the cap rates went down. Now, I say weirdly, but a lot of cap rates are tied to interest rates in a sense. So interest rates went down, so that's understandable, right? Returns, yields went down. But in certain product types, in certain markets, cap rates went up. I'm selling 2 fourplexes right now in Oakland at 7 cap rates. I haven't done a 7 cap rate deal in Oakland in a while. I don't even remember. To be honest with you, I think it was probably 14 or 15. Everything's been way under 7% cap rate, but I'm doing a 7% cap rate. Yet and still, I know of a deal in a nicer area that closed at high 3% cap rates. So, keep your eye on what's going on. Understand the cap rate for your building and for your market. Cash on cash return is your cash flow divided by your initial investment. You got to make sure you're making money on your investment, all right? Or at least that if you're getting a value added or development, whatever, that there is a potential to make money, all right? You got to understand the return on equity. Now, this is more of a measure for when you own property and you're trying to figure out, should I exchange? How much money are you making on your equity? Not the investment you bought the property with, but the equity that your investment grew into. Can you sell that property and go buy another property? Well, if you do it in the top of the market, you can make a ton of money, but you got to buy at the top of the market. So you got to have a good plan. All right. So you got to evaluate that. Also, the unit mix and desirability. What do people want in your market? Do they want 1 bedrooms, 2 bedrooms? What do people want in your office space? Do they want 10,000 square feet? They want 2,000 square feet? What do they want? What is the physical condition of the buildings that are selling or leasing? Right? You need to be competitive in the marketplace, right? And you're looking at buildings. Is there value add potential? That's, by the way, how you look at appreciation in commercial real estate is, can we add value? Can we force the appreciation by increasing the net operating income? You want to buy in areas that are growth, that are in path of progress, that have job growth and all of that, so you can get appreciation happening just by the market. But you want to look for areas to add value to a property so you can force the value up. All right. And just a couple of opportunities and guidance. The world is different now. I think everyone needs to figure out how to operate virtually as much as you can, even though we're back in the markets. Meetings like these are going to continue. Whatever, a lot of people are having their rent collected online these days. There's several different apps where you can have tenants pay online, right? And you can look for properties and use technologies to help you to look for properties, evaluate properties, use these systems. You got to adapt to what's going on. You got to tap into your network and see where the capital is at. A lot of people, a lot of institutions have capital they're looking to invest. One thing that's really, I think, going to be consistent in 2020 is the flow of funds in real estate, regardless of what the interest rate and inflationary issues are. I think money will still keep pouring into our markets, right? And I think this will present a great buying opportunity and maybe one of the best in history, like we've had in the Great Recession. If we see a downturn in the market, which I don't know what's going to happen, I think we'll see it. We're seeing it settling down for sure. If we do see a downturn, I think this could be a great time to buy. And I think the key is to figure out how to solve problems. If you can be a problem solver, because I don't think we're going to see a crash in prices per se, but I think there will be several opportunities for you to solve problems and therefore create a lot of value. right? And these distressed assets, particularly I think retail, hotels, and those two, and then apartments on a case by case are going to be some great opportunities. And I think another thing to do with some of these properties is to repurpose. A lot of retail properties are being repurposed into housing or warehousing or just used for different purposes. Pay attention to that, right? Looked at, we talked about hotels, and I think a lot of hotel deals are being converted into apartments. Look for opportunities. Look for opportunities to do this. Now, I put this here as I did this presentation a few months ago, and I was saying look for hotels you can master lease because governments are looking for makeshift hospital beds. They're not really doing that now, but they sure are housing people. So look into that, all right? Because hotels, a lot of times, especially small, mid-sized hotels, maybe not in with the greatest amount of travel demand, are selling at discounts, and you can take those properties and convert them into housing and really do well, right? Looking into apartment buildings, what's the interesting thing is apartment buildings that have Section 8 tenants are now in demand, and they brokers across the country are calling it Section 8 federally guaranteed rents, right? And a lot of people haven't been paying rent over the pandemic. Section 8 has been, right? And so if that's something, if you're open to Section 8, then money like clockwork, right? I think agents and brokers need to learn how to work short sales. I think in the distressed market that will come at some point, the banks are going to want to do short sales more so than REOs. Because the REO, when they take the property back on their books, there's a lot of stuff they got to do. They learned how to do short sales in the last market cycle. So brokers and agents, we need to get trained up on how to work those short sales and work them efficiently so that we can, help this market, work through some of the distress that I think is coming. And at some point, the dust is going to settle and some properties are going to have to change hands. Properties that were not able to operate, businesses moved, and they're not coming back. Something's going to happen. That's your opportunity to get in there, take a property and repurpose it and do good for the marketplace, do good for your family and your portfolio.